Fed and the Treasury step in to backstop the banks. What does that mean for the markets? This is what you need to know before the bell. Of course, on Friday, the big news, Silicon Valley Bank was put into receivership. Over the weekend, the Fed came out with a bank term funding program in order to support the banks by taking in collateral at 100 cents of face value, regardless of what the underlying market value is. That'll give banks access to capital in order to meet deposit demands from customers. What does all this mean for the markets, of course? Well, first thing is that now Fed rate hikes have been basically put off the table. Expectations were that the Fed would hike to over 5.5% on Thursday. This morning, we're basically saying no more rate hikes. Fed Fund futures pointing to a 4.75% term right now. So again, the expectations for a Fed rate hike on March 22nd is now completely off the table because of this Silicon Valley Bank situation. Of course, this has also been spreading out to other regional banks as well. A lot of regional banks down sharply in terms of price as exposure, particularly to commercial real estate and other areas, starting to worry markets. Of course, consumers also worried about their deposits in the bank. The big risk here, of course, is a bank run where a bunch of depositors run out and demand money back from the banks all at once. And of course, because of fractional reserve banking, those deposits simply aren't there. Again, the reason for this Fed program in order to make sure that liquidity is available to meet deposits all across the country. Now, markets on Friday unfortunately took out not only the rising trend line from the October lows. Of course, we've been talking about this very important bullish trend line from that October low, talking about the 200-day moving average, of course, being a very critical support. We took all that out on Friday. So now markets trading below that very important support level this morning. Futures are basically about flat. S&P's down a smidge. NASDAQ is up a little bit this morning as money kind of rotates into that risk-off type scenario, looking for areas that are non-bank related. So technology getting a little bit of a bid here. Of course, as I said before, the one area that you'd want to be paying attention to in the event of some type of financial risk-off event. And again, we've said many times that the Fed was going to hike rates until they broke something. And when they did, you would want to be long Treasury bonds because that is the risk-off trade. When people want to be out of risk, they buy Treasuries. And that's what happened on Friday as the realization of Silicon Valley Bank came to fruition. Money piled into Treasuries in this risk-off bet. A very, very big jump in Treasury prices, big drop in bond yields, of course, on Friday. Definitely back on a buy signal on bonds, a little bit overbought here now short term, so expect a little bit of a pullback here. But again, it looks like now the bid into bonds may be here for a while. So again, we had added to bonds last Tuesday. That's been working out well so far. And again, this risk off bid may continue if there is more to this Silicon Valley Bank situation than just one bank. And of course, that is the one thing we don't know. Reminds me a lot of 2008 with Bear Stearns. There was just the one event. Everybody dismissed it as a one-off event. It wasn't. Is Silicon Valley Bank a one-off event? We don't know. We'll have to find out. But pay attention. Treasuries will tell you if that risk is spreading, but also pay attention to the markets here. So again, expect a little bit of a rally probably in the next day or so. Markets are very oversold. I'd use that rally to sell into and raise a little bit of cash until we get through this little period and know what we're dealing with. I'm Lance Roberts, and that's what you need to know before the bell.